The stock price for Plug Power Inc., NASDAQ Plug, is currently trading at $3.96, reflecting a significant intraday gain of 53 cents, or an increase of 15.64% as of 10 a.m. 31 seconds GMT-4 on October 13, 2025. This double-digit surge today might look like a simple continuation of the recent explosive rally the stock has seen, a run-up of over 240% in the last 6 months alone. But the deeper, more unexpected driver today is the sudden re-rating of hydrogen as the AI energy trade. Most investors focus on the company's traditional material handling business or its slow path to profitability, but the market is now quickly projecting a future where the massive power-hungry data centers built by companies like NVIDIA stock and Apple stock need reliable, green, and on-site power solutions that Plug Power's hydrogen fuel cells and electrolyzers are perfectly positioned to provide. That's the real narrative creating this gap-up move. The prevailing market belief about Plug Power, especially among general online investment communities and those using platforms like Robinhood for self-investing, is that it is the quintessential speculative green energy stock, high potential, high cash burn, and perpetually struggling with negative gross margins. The reality, however, is that recent corporate and financial moves have quietly de-risked the company in ways the broader market hasn't fully digested. For instance, the company recently secured a massive warrant inducement agreement that raised $370 million in gross proceeds, with the potential for an additional $1.4 billion if new warrants are fully exercised. This addresses the single biggest concern, short-term liquidity, even while acknowledging the immediate concern of potential share dilution. Furthermore, they've recently appointed a new president, José Luis Crespo, who is focused explicitly on disciplined execution and cost controls, a signal to institutions that the party of unrestrained spending is giving way to a more pragmatic, financially focused management style. This management transition, effective just last week on October 10, 2025, is a major, underappreciated catalyst that suggests the company is serious about its stated goal of achieving positive gross margins by the end of 2025. This tension between the speculative hydrogen stock expectation and the de-risked, execution-focused company reality is what is fueling this substantial upward movement and forcing a dramatic reassessment of its near-term valuation. Looking closely at the recent stock movement, the current move is clearly one of strong momentum, bouncing sharply from the low set on October 10th. After hitting a recent 52-week high of $4.58 on October 6th, the stock experienced a healthy, though sharp pullback, closing last week at $3.42. The open today near $3.66 and the immediate sprint past the $4 mark, hitting an intraday high of $4.07 as of the latest data, demonstrates heavy institutional buying volume responding to the shifting narrative and the positive management changes. This is not purely retail excitement driven by message board sentiment, but rather a structural reevaluation by larger players who see the combination of federal loan guarantees, like the $1.66 billion loan guarantee from the U.S. Department of Energy, and the growing unforeseen demand from the artificial intelligence sector as a credible runway to actual gross margin stability. The fact that electrolyzer sales were up 230% year-over-year in the first half of 2025, now accounting for a notable 18% of the top line, shows the fundamental business shifting away from just material handling and toward large-scale industrial hardware, a much higher value segment. This segment is directly connected to the AI energy narrative, as massive data centers are actively seeking decentralized, high-capacity, and clean power solutions. Platforms like Interactive Brokers, with their detailed analytical tools, would be showing a clear uptick in accumulation metrics for Plug over the past 48 hours, signaling this institutional conviction. The core business model of Plug Power centers on a vertically integrated hydrogen ecosystem. This means they are involved in everything from producing green hydrogen itself through their own network of plants, including a new liquefaction plant in Louisiana and ramping up production in Texas and Georgia, to building the electrolyzer stacks that create the hydrogen and then manufacturing the fuel cell systems that consume it, primarily for forklifts and backup power. While their established material handling contracts with giants like Walmart and Amazon provide a base level of recurring revenue, the excitement and the entire premise of the stock's resurgence in 2025 lies in the electrolyzer and hydrogen production side. For years, the criticism has been that their costs of hydrogen production were too high, forcing them to sell the fuel at a loss, which created their perennial negative gross margin problem. The strategy now is scale. By commissioning multiple large-scale green hydrogen plants, they aim to drive down the cost of green hydrogen and reach break-even gross margins on a run-rate basis by the fourth quarter of this year. This expectation of scale finally overcoming cost is the crucial turning point. If you are comparing this stock against others in your intelligent portfolio on a site like SoFi Invest, you have to realize that this is a completely different risk profile now than it was just a few months ago, precisely because of the commissioning of those production facilities. Now let's talk about the next 10 days for Plug Power stock. The immediate price action as we see it is highly sensitive to technical levels and news flow. Today's 15% move pushes the stock back into a critical zone. The high from October 6th was $4.58, which now acts as the major overhead resistance. Given the momentum, a retest of that $4.50 to $4.60 level is highly probable within the next 3 to 5 trading days. If the stock can consolidate around the $3.80 to $4 range for the rest of today and tomorrow, it sets up for a clean run at that high. The biggest immediate catalyst beyond the general AI energy hype is continued confirmation of execution. Investors will be hanging on every press release concerning the successful commissioning of their new hydrogen plants, particularly the Texas and Georgia facilities. Any firm news of successful ramp-up or new large-scale contracts with data center operators or utility partners could send the stock blasting through the $4.60 resistance, potentially setting a new 52-week high north of $5 before the end of the next week. The technical setup, combined with the momentum from the analyst community, where a prominent analyst recently set a street-high price target of $7, suggests a strong bias towards the upside in the very short term, provided the overall market for clean energy and growth stocks remains cooperative. However, the risk is not insignificant, and this is where the expectation versus reality tension comes back into play. The reality is that the next major financial checkpoint is not until the estimated Q3 2025 earnings report around November 11th. In the 10-day window leading up to the report, the stock will likely become a lightning rod for volatility. Analysts are forecasting an EPS loss of about -$0.13 for the quarter ending September 2025, a significant improvement from the -$0.25 loss a year ago. What will really matter, though, is the revenue figure, and more importantly, the commentary on gross margins and cash burn. If the street begins to seriously doubt the company's ability to hit that late 2025 gross margin break-even target, the core expectation driving the current stock price, the floor could give way very quickly. A short-term drop back to the $3.20 support level, which was a key area of previous consolidation, would be entirely possible if a major financial institution issues a bearish report arguing that the execution risks outweigh the AI narrative benefits. Furthermore, the company's continuous need for liquidity has led to shareholder dilution in the past, a persistent worry that has plagued the stock for years, and is why many investors prefer a diversified approach through platforms like Fidelity's full-service individual brokerage or Schwab Intelligent Portfolios. For investors on platforms like Robinhood or SoFi Invest, where a single large trade can impact the daily movement, this volatility presents both opportunity and significant hazard. The macroeconomic environment is also a factor to consider in the next 10 days. Should we see any unexpected spike in interest rates from the Federal Reserve or a sharp sell-off in the broader tech and growth sector, which often hits stocks like Plug Power, Tesla stock, and Nvidia stock, the enthusiasm for a speculative growth name like Plug will evaporate regardless of company-specific news. As a high-beta stock, it acts like a lever for the entire clean energy sector. But for now, the momentum is positive, driven by the narrative that hydrogen is a credible solution for the rapidly accelerating energy demands of AI data centers. This demand is a fundamental shift that may finally provide the massive, predictable offtake contracts Plug Power has needed for years to achieve economic scale. The former narrative was always about industrial forklifts. The new, more potent narrative is about powering the entire digital economy, which changes the game completely in terms of addressable market. We must remember the core challenge, which is cash flow. The company still burned through nearly $300 million in cash from operations in the first half of 2025. While the new financing helps, this company must transition from a capex-intensive builder of infrastructure to an operating business generating positive cash flow. That is the ultimate reality that must exceed the market's high expectation. The current stock price is a direct function of the market giving the new management and new narrative a brief window of trust. That trust will be tested severely in the next month. The next 10 days will be dominated by technical trading and momentum chasing, likely driving a retest of the $4.58 high. The period immediately following, leading up to the November earnings date, is when the true pressure mounts. The question isn't whether green hydrogen is important. It is, but whether Plug Power can execute its complex, capital-intensive strategy before it needs to go back to the equity markets. The long-term story relies heavily